Now, in this segment, we're gonna stick with the U.S. a bit more, but we're gonna look at it a bit differently and show just how bifurcated some of these data points are and why we think there's going to be that snapback, which will be supportive of rates going up further and some of that slowdown that we're seeing in some of these numbers that have been very resilient and very a bit stronger as we go into the end of Q1. So this is just going to look at PMI, which obviously was very strong, and there's really nothing to say that it shouldn't have been strong based on the underlying components. But the bigger issue that we see going forward is, and this is a quote from the actual document, business sentiment remains buoyant, boosted by hopes of further stimulus and the vaccine rollout. But it's disappointing to see this not yet translate into stronger jobs growth, which was what we keep talking about when we look at jobs in general. And all of those leading indicators are showing that we're not going to see that. And as margins get compressed, it's going to limit the amount that they have to hire anew. It'll keep manufacturing active. It'll keep GDP moving in the right direction, but it's not going to bleed down into more employment and better consumer spending in the near to medium term, which is a bit more of a problem. Many service sector firms in particular remain reluctant to hire, cautious about adding to overhead. A concern is that firms' costs have surged higher, driving selling prices for goods and services up at a survey record pace and hinting at a further increase in inflation. This is what we keep talking about with a concern is that firms' costs have surged higher, and that's where we get this bifurcation between prices paid and prices received, where companies are struggling to push down some of these price increases because the consumer, based on wage compression, based on inflation that they're already experiencing, based on lack of jobs and or concern about future employment, is mitigating their ability to spend more, again, kind of capping some of this push through. Now let's look at this in different levels. Now, output prices is where you can see the output and the input prices. And then we look at prices changed and input prices. So let's take the one on the left. These will move. They don't have to marry perfectly. I'm not saying that they're going to immediately meet and everybody's going to be in trouble. It's showing direction. So output prices are at a pretty much going back to 2011, an all-time high on this chart. And then you look at input prices, which are back to levels in 2013. So we are going to push higher just given the increase in cost at the business level. But the prices that you can push through are already near a high as input prices hit a new record. So input prices are at a record high, and you've already pushed through a significant amount of price changes, but how much can people really digest given the difficulties that they're having on their own personal level? Again, this is why we're talking about what Biden is going to do on the stimulus plan. And this gives support to providing some of that stimulus to try to help people that are struggling, because one, it would help the company because they can push through more price increases, but it would also help buffer some of the issues that the consumer is having on that end. And this is just looking at it in a different way. This is taking the Philly data that came out. Remember, the Philly data on the manufacturing side was really good, but we are seeing this difference between prices received, which are still low, and prices paid. And this has to be pushed through. Now I'm not saying it's going to marry perfectly, because if you look in January, you had a spike in prices paid, and then you had that drop, and you never saw the prices received marry into that. But this is a little bit different. We've had some chop and now we're going up. And if we are really in a recovery backdrop, you're not going to see these prices paid fall too much. They'll normalize. I mean, clearly you can see you get spikes and fades. But when we look abroad and we go through the remainder of the supply chain, export prices, import prices are going up. You have inflation on the commodity side, which is bleeding into the rest of the supply chain, which is going to support those prices paid, and you're going to have to push some of that price increase through to the underlying consumer, which is why the Bloomberg Consumer Comfort Index remains under pressure. People are seeing this inflation. They're starting to feel this inflation, and the Bloomberg Weekly Consumer Comfort Index ticked up slightly yesterday, or 2 days ago based on when we're filming, to 45.8, still off recent peaks of 49.8 in September and November, but still well below those pre-pandemic levels, because people still don't feel that comfort, because there's still those issues that are running through not only just their jobs, their paychecks, but also just what they're spending in the market. So then when we look at this I thought was a very good report that came out from the Federal Reserve. This is showing that bifurcation. Employment declines for low, middle, and high wage workers. So you can see here, the top, middle, and the top are in a good position. Still not back to where we were, but in a better position than when we look at the bottom and the middle. They're rolling over, and that bottom index continues to be under pressure. Again, showing that separation and why these individuals at the lower end are not seeing the same type of job opportunities or seeing that wage compression, which is creating that underlying pressure, which it's not that it's going to pull the economy down. It's just going to act as an anchor and really hurt the ability of getting that and lifting off. Like everyone likes to think that we're taking off, but it's because the top, middle, and that top component make up, let's say, 60% of spending. You're not gonna, you're still gonna get that buoyancy within it, but the other 30% or 40%, depending on the the breakdowns that we have, aren't there, and is gonna be that weight that is gonna keep and kind of hold back some of that growth. And said a different way, this is looking at the Conference Board Consumer Confidence Index. You can see the confidence index is better, but we're still not getting to those levels because present conditions remain weak. Expectations remain mixed and subdued, and that's impacting consumer confidence. So you have consumer confidence going from 91.3 from 88.9 in January. Present situation went from 85.5 to 92. Expectations index fell from 91.2 to 90.8. So people are feeling a little bit better about their current situation, but are looking forward and saying, well, that looks a little concerning, and I want to be a little more cautious with what I keep in savings and what I'm protecting myself with. And this is one of those reasons on why we're going to continue to see the problems where freight rates from East Asia to U.S. East Coast and Europe, and container rates from Asia to U.S. and Europe remain elevated. And this is, we're not seeing it, we're seeing it flatline, but we're not seeing it fall. And based on where the demand is, the shortage of containers, the prices aren't going to drop anytime soon. And that's just going to keep support of the prices paid, and is why we're going to see that margin compression, which is going to get pushed through, or they're going to try to push as much as they can through to the consumer. But they're also looking to mitigate some of those new orders. So now let's look at Richmond Fed manufacturing expected new orders. You can see that it had some pressure and it fell. This is what we've been talking about when we look at some of these data and we look at towards the leading indicators. You can see that pressure to the downside. And it hasn't been just this straight drop like we saw in 2020. This is very much a staggered where we're getting lower highs, lower lows, and just showing some of that pressure that is continuing to go through the system as new orders slow, which is pointing to a little bit of that cap that we're talking about with growth going from Q1 into Q2, which is being picked up in the New York Fed data. Now, conference board labor differential, you can see that people are still concerned about getting jobs. They're still struggling. This is hard to get versus jobs available, and we're still kind of sucking around this zero. And this is the difference, because the efficiency of the jobs market has become a problem given the amount of job openings are there, but the marrying of skills isn't. So that's where you're going to see, well, if I'm going to take a risk and hire someone that doesn't have the skill set, I have to train you. It costs me money. It's going to cost me productivity. So I'm going to charge you, or I'm going to offer you a lower salary. And these are things that are weighing, and why we've seen a very lackadaisical and very slow recovery, which is what we called for in March, that we were going to get a sharp bounce off the bottom, but then we were going to start to flatline and go sideways a bit and just waffle back and forth. And we were going to be about 50% below normal. And this is kind of what we have been talking about in a different type of chart form. Now, with all of that being said, here's looking at farm products, grains, in case you weren't sure. I will show this chart in many different times in many different ways where you can see just the amount of grain pricing continuing to go higher. And as we've said in the past, this was started in 2014 on food security issues, and it's only gotten worse, especially with China now facing a new round of swine flu and avian flu, specifically swine flu, in northern provinces, which have caused them to call I don't want to say a large size, but enough of a size of the recovered herd where that's going to be a bigger problem, because they were only about 90% back to where they were. They were still not 10% off. And this is just going to slow down that recovery. But at the same time, it's going to put them in the market to buy more feed and buy more stuff to try to feed these pigs and grow this herd to get it back to where it needs to be. And even when we talk about food, we also have to consider what are about health services. And when we look at outpatient care, inpatient care, health services, guess what? It's going up. And my father, who's the CFO of a orthopedic group, he said to me, he's like, our costs are just through the roof because everyone is scrambling to buy stuff. I mean, and if you think about the care, health services, just the input costs are going up, and there's only so much you can pass through, which again is squeezing some of these margins that we've talked about, especially on the health service side, which will lead to more inflation. Now, when we look at that PPI final demand, the PPI less foods and energy, just look at the spike in that chart, like on both sides. Month over month, the final demand less food and energy. The core one is the one that a lot look at in terms of, and especially the Fed. That PPI number is shocking, and it will normalize. I'm not saying it won't. I'm just saying it's not going to normalize back to where it should be, because there's so much pressure in the market as the purchasers, the companies are struggling. So on final demand, it's up 1.3 on core, and that's less food and energy, and because as we talk about, diesel prices are going up, gasoline prices are going up. Crude going to 63.16 is going to increase the price of refined products. I mean, that's just the way it is. The refiners are pass-throughs. They are trying to make money by taking feedstock, but how much is this going to impact the activity of the consumer, because there's so much price that is just, again, the inflation that we continue to see. Now, when we look at looking at a different Fed, now, because we like to look at multiple Feds to make sure that we're not overweighting one versus the other, because Philly could say something different than Dallas and St. Louis. So this is just looking at manufacturing in Dallas. And it's something similar, just not to the severe downturn, where when we look at, again, lower highs, lower lows, it's just we're moving in the wrong direction on the future on expecting new orders, which just means that manufacturing capacity is starting to slow and just not so much going to drop immediately, but we're starting to see the pressure come in, which is just going to mitigate some of the hiring and some of the ability of the GDP normalization. Now, let's look at this a little differently. The Philly Fed manufacturing average employee work week is up. It's strong, which is good because the workers that they have are being optimized. They are working more, and that's allowing them to get a higher productivity, reduce some cost, because when we look at the go forward, the Philadelphia Fed manufacturing expected shipments dropped with the expected orders, not surprising, but the expected average employee work week also fell. So it's if you look, things normalized. They've make sure that you have the inventory, refill your inventory. Now that you've refilled your inventory, your expected shipments are dropping a bit, costs are going up, margins are getting squeezed. Well, let's start to see if we can reduce the work week. But if you're reducing the work week, then you're not going to have any propensity to hire someone new if you have gone from the current maximized efficiency to a little bit less efficiency. Again, this is just showing some of the pressure that's going to remain in the jobs market. And then the Richmond Fed manufacturing availability of skills needed is just driving home what we've said, where the jobs are available, but they don't have the skills needed. And this is where we continue to see this friction point, and we're just not seeing the efficiency in that in the employment market. Now, this is showing that in a different way. This is looking at current number of full-time permanent employees and current number of part-time employees. So the full-time employees, it's going down, but part-time is going up. Again, the efficiency of the work week, the employee backdrop, this is where we continue to see some of this spike in employment on the part-time side, but those full-time jobs are still few and far between as people are opting to pick up more of that part-time work to just kind of bridge some of this gap. Now, when we think about, okay, well, all of this is happening, but yet we see everybody and their mother buying homes. Well, who is buying a home? Americans with top credit scores flooded the market, and we've been talking about this nonstop. This is not something new that we've seen. 760 or better are crushing the market. They are the ones getting the borrowing. They're the ones that are getting the mortgage. They're getting the premium rates and enabling them to go from the urban to suburban and optimizing their capacity because they have the credit score and they have some cash in the bank that they can deploy. Now, again, the U.S. personal savings has gone up. It's flatlined. It will be supported now by Biden's plan of $1.9 trillion that will come into the market. But you can see how quickly it spiked and how quickly it faded. This is speaking to what we're talking about of the bifurcation in the savings market. The top two quartiles have savings. They are 99%, or I should say at this point, 120% of that savings rate because the bottom three quartiles are bleeding through savings. So even though this number as an aggregate looks really good, you have to separate it into its key components, and that is putting pressure on the underlying piece of the lower pie. And then when we think about Powell saying, if you own assets, you're fine. If you don't, well, sorry. This is that chart in a nutshell. Because here you can see the purchase-only house price index, which has exploded, and you can see the rate of change has just gone parabolic in 2020 to 2021, while earnings has stayed flat. And this is what we keep talking about. It's becoming much harder to get the American dream. And if you don't already own something to capture the equity in your home, well, how are you ever going to go into this? Because the competition is increasing, the price is going up. You're going to have less money to put down. Your wages aren't going up enough because the wage inflation isn't maintaining with regular inflation. Again, these are issues that are just causing a much bigger problem. But while all of this is happening, we're seeing the mortgage-backed securities versus long-duration treasuries. This is where we look to what is the problem in the market. And the MBS outperformed during the 2013 taper tantrum. There is no taper tantrum. There is nobody in this market right now that has mentioned the word taper. If anybody has listened to any one of those central bankers, the last thing they have said is taper, but yet we're having a fear coming to law of diminishing returns, the ability of them doing something to offset that. How much bigger can it get? And this is going to be something to watch as we keep talking about what is that duration risk going to be. Now, even while coming to taking money out of your home, people have looked to take equity out of their homes through their last refinancing because I can take a rate maybe when I bought my home back in 2010, 2011, 2012, 13, you got 4.5%. Now I can get 2.5% and I can take some money out. That's something that is happening here. Now you're capitalizing on this equity. Again, you have to be in the top quartile or a 760 or better to get that premium rate. And that is where people have taken that equity out and gone into savings or expanded their home, done more with their house. These are things that have happened that need to be considered as to what is some of the benefits that we've seen. And this is one where they've taken equity out of their homes, realized some of these gains that we've seen in the market, given the fact that home prices have rallied so extensively. And when we say that they've rallied extensively, this just puts it into view. And this is also something that says that urban to suburban is happening, but there's also an urban component to this, and you can see that prices continue to go up with the measure being house. So in December, a measure of U.S. housing prices in 20 cities rose at the fastest pace since April of 2014, boosted by record low mortgage rates and housing inventory tightness. Now let's look at this a little differently. Now, the Federal Housing Finance Agency, the FHFA, Purchase-only price index rose 11.4% year over year in December, the largest increase on record and up from 11% in November. These are the federal housing ones. These are not the jumbo ones. These are not what the rich people are buying. This is for the lower end as well. Speaking to, if you remember what we just talked about, the lower end of that employment pool is getting squeezed, but yet their price index is going up because those at the top that couldn't afford a $1 million home have to now buy a $750,000 home, have to then buy a $500,000. And again, it keeps going down as people get squeezed at the top where, 10 years ago, you could buy a $1 million home. Now, under the current rates, what's happening, it's $750,000. And then that's, again, you're seeing that pressure come through, which is just putting pressure all the way down the pricing spectrum. And this puts that into perspective. The U3 unemployment rate is technically at 6.3%. But if we look at misclassified or absent from work and then plus decline in the labor force participation rate, U.S. unemployment rates are much higher, closer to 10%, which is why they also say that they need support to help these individuals that are currently struggling. But when we look at what does struggling mean, you can see that everyone is still looking at the purchasing. We still see retail sales that were up. They even seasonally adjusted, they were much stronger. Even not seasonally adjusted, they were stronger, not to the same level. But again, you're seeing that a lot of this is going in the U.S. e-commerce side. This speaks to how many people are actually going into the store. What does foot traffic look like? And this is that shift from in-store to online. And it's going to be difficult to see what that looks like because when we go back to 2018 to today, the trend was already going up. And now that it's accelerated, I don't know how much you're going to see this adjust. It'll come down, it'll average out, but this is also showing a certain amount of stickiness and growth and the speed of adoption. Then because people were forced to do it and now they got used to it. They kind of like it. They miss going to the store a little bit, but not a whole lot. So maybe they'll still go to one store, but some of these things that they buy every day will just get sent to the home. This is something that is going to impact, again, that total gasoline demand versus optimization of the logistical chain. That's going to essentially soften or make that diesel consumption a bit more optimized and the limit in general. And this is just looking at that labor demand shift. 1 out of every 10 U.S. workers will likely be forced to take up a new occupation by 2030, as per McKinsey. The pandemic has destroyed large swaths of low-paying positions, which will cut demand over time, forcing a shift for 17 million workers. About 17 million, we've said the number 20, 17, 20, if you want, split the difference. Here's where you're seeing some of those issues in office support because commercial real estate is going to shrink, service and sales, production, food services. This is that shift that we continue to see of how are people going to retrain from one to the other. Then when we take that to the next level, well, let's change in job position postings since February. The job postings are there. We've seen this, Indeed.com has covered this. Job postings since February 2020 are above zero. They're out there, they're available. It's just where are we seeing some of these people, and we're just not seeing those jobs getting taken as we look at that all jobs, and it's being pulled higher by the construction, which shouldn't be surprising given where construction is in warehousing, given logistics importance. But the change in payroll, here you can see manufacturing and non-pharma is going down, warehouse is coming, it's starting to normalize, and we're seeing this roll over and change in payrolls, and that's what we're seeing in terms of full-time versus part-time, some of these pressures that are coming into the market. And this is showing that wage compression as the competition increases for those jobs. And this puts that into a different perspective. Let's look at the pandemic low in general. So when we look at the original baseline projection of growth and then the impacts, you can see bottom, second, middle, saw this huge compression in what the available jobs are going to be, where the top quartile, fourth quartile aren't seeing that. Again, the top two versus the bottom three is a big problem and a big shift in the underlying market. And this looks at it where let's break that into pieces. Well, let's look at what is going to remain under pressure. And I don't think anybody's going to be surprised to see bartenders, hotels, motels, resort desk clerks, waiters and waitresses as ones that are going to be impacted the most versus some of the more educated STEM type jobs. And again, coming to the availability of job postings, but then the actual person who can get that job, there is a huge disconnect between those two. And while this is happening, people are looking to day trade. So the rise of retail trade continues. You can see here just the amount of people that are searching. This is looking at Google searches for day trading, options trading, and swing trading, and just trading strategies in general. People are Googling what are they going to buy and how do they do it. Now, when we take that and look at the Chase Consumer Credit Card Spending Tracker, you can see it's down. Obviously, the big drop, you have to factor in the fact that weather was terrible, as we talked about in the EIA show. So that's going to mitigate some of the consumer spending, but that will come back. The problem is the trend has been sideways, and it's just showing that we're really not getting back to where things are. And even with some of this reduction, I don't see this adjusting too much. We will get a spike, as we did after the first benefit of CARES Act. But again, it's just people are going to look to do less with their money in general. And this is looking at it a little differently, because millennials and Gen Z, they're still spending above back to pre-COVID, but Gen X and baby boomers have really cut down. And it comes to, well, who's going to continue? Because baby boomers and Gen X are ones that own more homes. They have more equity that they can get down. So we're hoping to see some of this turn around a bit. But again, you can see how convoluted and complicated this can get when we're looking at the good and the bad and trying to see what is going to win out over the next few quarters, given where we sit on the COVID recovery cycle, if you will, which is going to remain interesting over the next few months. But now that we've covered most of the, pretty much the U.S. inside and out, we're going to turn to Europe and look at some of these European indicators that we think are very important for how quickly will European recoveries go, and what does that look like as we go into the end of Q1 and springboard into Q2.